In the summer of 2001, a $2 million Roman-themed birthday party unfolded on the Italian island of Sardinia, featuring an ice sculpture of Michelangelo's David that dispensed premium vodka. This extravagant spectacle was not funded by a private billionaire's personal fortune, but quietly subsidized by the shareholders of a publicly traded manufacturer of electronics and security systems. It was a symptom of a staggering financial paradox. While investors believed they were backing a disciplined, growth-oriented conglomerate, they were unwittingly financing the private treasury of a single executive. The architect of this deception was Dennis Kozlowski, the chief executive officer of Tyco International, who, alongside his chief financial officer, orchestrated one of the most brazen corporate looting schemes in modern history. Corporate looting, the systematic extraction of a company's assets for personal enrichment by its own leadership, requires both audacity and structural vulnerability. Unlike schemes that rely on complex off-balance sheet entities to hide toxic debt, this extraction was remarkably direct. It was not a matter of hiding losses, but of outright taking cash. Kozlowski and his chief financial officer, Mark Swartz, siphoned hundreds of millions of dollars directly from the corporate treasury. They achieved this by exploiting executive compensation mechanisms, transforming legitimate corporate retention tools into a private, unregulated bank. The narrative focuses on how these two men bypassed every internal control designed to protect shareholder equity. The primary vehicle for this extraction was the Key Employee Corporate Loan Program. Originally designed to help executives pay taxes on vested stock options, the program was quietly hijacked. Kozlowski and Swartz weaponized it, drawing down massive, interest-free loans for personal use without ever seeking the required authorizations. Millions flowed out to purchase luxury real estate, yachts, and fine art. The executives utilized the company coffers as a limitless personal checking account, operating under the assumption that their immense power within the organization shielded them from scrutiny. Another critical instrument of deception was the relocation loan program. Ostensibly created to assist employees moving to the company's new offices, the executives manipulated this fund to acquire extravagant personal properties. Kozlowski utilized these relocation funds to purchase a $30 million apartment on Fifth Avenue in New York City, alongside an estate in Boca Raton, Florida. To conceal the true nature of these withdrawals, the executives simply bypassed the board of directors, instructing compliance subordinates in the accounting department to process the massive disbursements without asking questions. Taking the money was only the first step. Keeping it required a secondary, far more insidious layer of deception. When the unauthorized loan balances swelled to indefensible levels, the executives initiated covert debt forgiveness. They manufactured internal bonuses entirely unapproved by the compensation committee, specifically sized to offset their outstanding loan balances. In corporate accounting, this effectively erased the debt from the personal ledgers of the executives, burying the cost deep within Tyco's operating expenses. They even authorized the company to pay the income taxes owed on these phantom bonuses, a practice known as grossing up, further draining corporate resources. The success of such a brazen operation raises a critical question regarding corporate governance. How did a sophisticated board of directors remain oblivious to the disappearance of hundreds of millions of dollars? The answer lies in the cultivation of a compliant and compromised oversight body. Kozlowski ensured that key board members were heavily compensated and occasionally directed lucrative corporate contracts to their affiliated businesses. One director secretly received a $20 million finder's fee for helping orchestrate an acquisition. This environment fostered a culture of deference, where the chief executive's authority was absolute and his financial directives went unquestioned. The internal calculus of the perpetrators was rooted in a distorted sense of entitlement. Kozlowski had transformed Tyco from a modest manufacturer into a global powerhouse through a relentless, aggressive acquisition strategy, buying hundreds of companies in a matter of years. As the company's valuations soared, so did his belief that the corporate treasury was indistinguishable from his personal wealth. The staggering sums stolen were rationalized internally as just compensation for the immense market capitalization he had generated. This unchecked ego blinded the leadership to the fundamental fiduciary duty owed to the shareholders who actually owned the enterprise. Nothing epitomized this distorted reality more than the infamous $6,000 shower curtain, Purchased for Kozlowski's Tyco-funded Manhattan apartment, this single item became the enduring symbol of the entire scandal. It was not merely an extravagant purchase. It was a testament to the utter detachment from financial reality. When corporate funds are utilized to acquire a $15,000 umbrella stand, a $2,000 trash can, and a $6,000 shower curtain, the internal controls designed to prevent fraud have not just failed, they have ceased to exist. The unraveling of this massive deception did not begin with a whistleblower or a forensic audit of the company's internal loan programs. Instead, it was triggered by a seemingly unrelated investigation into state sales tax evasion. The Manhattan District Attorney's Office began scrutinizing Kozlowski's purchases of fine art. Investigators discovered that millions of dollars in paintings, bought in New York City art galleries, were allegedly shipped to empty boxes in New Hampshire to avoid millions in state taxes. The art actually went straight to his Fifth Avenue apartment. This tax inquiry acted as a thread that, once pulled, unraveled the entire corporate tapestry. As prosecutors subpoenaed financial records to trace the art purchases, they stumbled upon the source of the funds. The money trail led directly back to the unauthorized corporate loans and the unapproved bonuses. The district attorney's office, alongside the Securities and Exchange Commission, quickly realized they were no longer looking at simple tax evasion by a wealthy individual. They had uncovered a systematic, executive-level robbery of a Fortune 500 company. In September 2002, Dennis Kozlowski and Mark Swartz were indicted on charges of enterprise corruption, grand larceny, and securities fraud. The use of the enterprise corruption statute, typically reserved for organized crime syndicates, underscored the severity and coordinated nature of the fraud. The indictment detailed the theft of more than $170 million directly from the company, and the illicit gain of an additional $430 million through the fraudulent sales of company stock. The sheer scale of the alleged crimes sent shockwaves through the financial markets. Investors, already battered by the recent collapse of other major corporations, watched in disbelief as the executives of a seemingly stable conglomerate faced decades in prison. The stock price plummeted, erasing nearly $90 billion in market value over a period of months. The revelation that the company's growth was partially a facade, masking a culture of unrestrained greed, destroyed investor confidence. The lavish lifestyle of the few was now directly subsidized by the financial devastation of the many, as pension funds and individual retirement accounts absorbed the catastrophic losses. Thousands of ordinary employees whose livelihoods and retirement savings were inextricably tied to the company's performance saw their financial security evaporate. During the subsequent trial, the defense strategy rested on a bold, if controversial, premise. The executives argued that they had not stolen anything, asserting that the board of directors knew about the loans and bonuses, or at least should have known. They claimed their actions were standard practice in the high-stakes world of corporate leadership, and that the external auditors had signed off on the financial statements. This defense attempted to normalize the extraordinary extraction of wealth, framing it as a mere misunderstanding of complex compensation packages rather than intentional criminal theft. The first trial ended in a highly publicized mistrial after a juror received a threatening letter, but prosecutors immediately regrouped for a second attempt. In this subsequent proceeding, the government meticulously dismantled the defense's narrative. They presented a mountain of documentary evidence, including internal memos and accounting entries, proving that the board was deliberately kept in the dark. The prosecution demonstrated that the executives actively hid their massive withdrawals, proving criminal intent beyond a reasonable doubt. The jury ultimately rejected the normalization of greed, finding both men guilty on nearly all counts in 2005. The consequences were severe and unprecedented for corporate executives of their stature. Both men were sentenced to 8 1/3 to 25 years in state prison and ordered to pay hundreds of millions of dollars in restitution and fines. The convictions signaled a definitive shift in the judicial approach to white-collar crime. The era of treating executive malfeasance as a victimless administrative error had ended. The justice system had finally recognized that stealing from shareholders with a fountain pen was just as criminal as robbing a bank with a weapon. The systemic impact of this scandal fundamentally altered the landscape of American business. It served as a primary catalyst for the Sarbanes-Oxley Act of 2002. This landmark legislation mandated strict corporate governance reforms, requiring executives to personally certify the accuracy of financial statements under penalty of perjury. Crucially, it specifically outlawed the very type of personal corporate loans that Kozlowski and Swartz had exploited. The regulatory framework was forcibly upgraded to prevent a recurrence of such blatant internal looting, demanding a new era of transparency and accountability. The story of Tyco International under its former leadership is not merely a historical footnote about a lavish party or an overpriced bathroom fixture. It is a forensic case study in the corrupting influence of unchecked power and the catastrophic failure of corporate oversight. It demonstrates how quickly a culture of aggressive growth can devolve into a culture of entitlement, where the guardians of a company become its primary predators. The legacy of this massive scheme continues to serve as a stark warning about the necessity of vigilant governance in the face of limitless executive ambition.